Okay. So, in the last recording, we were discussing about the supply of money, which we saw that RBI has, RBI is responsible for supplying the money in the economy, and at the macro level, at aggregate, it is nearly constant. In the short term, to increase it, of course, you have to increase the GDP of the country. You have to increase the amount of money in circulation, and that happens because of certain monetary policy and fiscal policy and also external factors. We'll discuss that later. Then we were discussing about the demand for money. We checked that there are mainly two demands for money. The first is the transaction motive, and the second is speculative motive. This is something which has been discussed majorly by Sir. So transaction may we can just understand that it is the demand for money. Uh, and whenever I'm talking about demand for money, I'm talking about the demand for holding liquid money in my hands as compared to investing it off in bonds. We will discuss that in just a while. So this demand for money for the purpose of transaction, it is directly proportional to the real GDP. Okay, real GDP we know whenever we are taking off the account the effect of inflation, that part of GDP is known as the real GDP, and then so this is directly proportional to the real GDP because as the GDP in this country increases, the people have more money in their hands. There is a general well of prosperity, so people would want to uh, keep money in their hands and transact it. So if my income is increasing, my consumption will also increase. As simple as that. It also depends. It is also directly dependent on the general price level. The general price level is nothing but what we known as the GDP deflator. Okay, a measure of inflation. Okay, so if the general price level is also increasing in the country, then the demand for transaction also increases. Okay, um, we are not going to discuss much more about this because it's not that important from the point of view of exam. We will mainly talk about what is the liquidity preference model. This term has been used by Sir in slide number 17. So I'll try to explain it in slight detail. Now, liquidity preference means the preference of the general public, and we had discussed that supply side is the RBI side where they are supplying the money. Demand side is mainly the public and also the commercial banks. So, as a general public, if I have, let us say, 100 rupees with me, my salary is 100 rupees. Now, I have two ways of keeping that money. Either I can keep it in the form of liquid, okay, if I have 100 rupees. Option one is that I keep it as liquid in my hand, I hold it in cash. And the second option is that I invest it. Now, where can I invest my money? Okay, considering that 100 rupees is sufficiently good amount of money, I can invest it in gold. I can purchase land out of it. I can invest it in bonds, securities. I can go for mutual funds. N number of instruments. But all of these, whenever I'm talking about investment, what is the advantage of not keeping this money in my hand as cash and investing it? The advantage is that not almost, all of them are going to offer me some market rate of interest. Yeah, this is how time value of money works. If I'm putting my money as an investment in any instrument, after n number of years or n number of time period, it will give me some R% rate of interest. Okay, so for the sake of this discussion, we are going to assume that this entire money this entire investment option, I'm going to call it just one single thing, which is bond. Okay, it can be bond, securities, debentures, gold, land, PPF, anything. I'm just going to call it bond, which is giving me R% rate of interest. Okay, now how will I compare? How will I decide whether I have to keep this 100 rupees as liquid or I have to invest it? Obviously, I'll use the concepts of financial management, which we now know. I'll calculate the present value of this 100 rupee which is required to give me some expected stream of returns in the future. So I'll calculate future value and I'll calculate all those things which are part of that FM subject, and then I'll compare it whether it is profitable for me to hold my money in liquid, or it is profitable for me to hold it in the form of bond. And of course, because we are studying economics, I will also take into account inflation. Okay, so whenever I'm talking about R% rate of interest, I will also consider the real rate of interest, which is rate of interest minus inflation. Okay, now why do people prefer to hold money in liquid? Why is there a liquidity preference? It can be for a number of things. It is not every day that I want to invest, right? If today I want to consume, I want to purchase a car, I want to purchase any commodity, I need that money in my hand in liquid. If there is a festival season, I need money to purchase clothes, gifts, sweets, and gifts for my relatives, right? And if I'm a farmer and there is an agricultural season, there is a harvesting season, then I need some money to take that harvest produce to from my farm to the market. Okay, so and of course I want to celebrate with my family, so I want to purchase sweets and clothes. So these are all my liquidity preferences. Okay. Uh, on the other hand, if I feel as a consumer that it is more profitable to keep my money in the bank, the bank is offering me big, a huge amount of interest. Let us say 7% savings rate interest. Then of course it is foolish of me to keep the money in cash and not keep it in bank. The opposite situation happened in COVID. We are not required to, specifically study what happened in COVID, how government and RBI dealt with it. But we know that during COVID, the government wanted to, you know, increase money supply in the hands of people. So they drastically reduced the rate of interest which was being offered by the savings banks. It came down to as low as 3%, so that people find it more profitable to extract the money and keep it in liquid form. And that was required in times of those emergencies. Okay, so this is how my liquidity preference will change. It will change based on my lifestyle. It will change based on the season and festival time of the year. It will change whether on my personal events, and it will also change on the rate of interest which is prevailing in the market. So personal preferences, I cannot really quantify them, but R% rate of interest is something which I will quantify. Okay, so this is something which is also mentioned in slide 17, 18, 19, that there is always an opportunity cost for holding the money. Okay, so there is always a trade-off. We have discussed this. I'm just reading it out. So there is always a trade-off between the demand for liquid money, which we call as liquidity preference model, and uh, the need for investing it in bonds. And what is this trade-off? What is the price which I pay? So if I'm holding my money in cash or in demand deposits, not in fact even in demand deposit, because this will also earn some rate. But if I'm holding it in cash, uh, the opportunity cost or the price which I'm paying for holding it in cash is the interest rate which I am willing to forego, because if I had invested it, I would have earned the interest rate. So that's the opportunity cost and the price of the best foregone alternative. Okay, so this is something you have to remember in speculative motive. This term is not used by Sir. The main term which is used is liquidity preference model, or you can simply call it as demand for money. It is one and the same thing. Don't get confused between terminologies. Uh, the simple concept is that there is always an opportunity cost for holding money, for demanding money in liquid, and that is the interest rate which you are foregoing. Okay. Now, based on this, we are going to draw the graph, and now it is more apparent why we always put interest rate on the y-axis. So this was not obvious when I had put the interest rate and y-axis in the supply curve. Why am I measuring the supply of money as against interest rate? But now it is more obvious, because I want to see what is the opportunity cost of keeping my money in my hand versus investing it. Okay. So coming here again, this is the interest rate R on the y-axis, and this is the money axis. Okay, so the demand for money is a negatively sloping curve, which means, and why does that happen? So you have already studied in FM that the price of the bond is inversely proportional to the interest rate. Why does it happen? Let us say I have a bond which is promising to offer me 100 rupees plus some interest, in the future. And so the price of this bond would not be 100 rupees. It is a competitive market. Please mind that. So that this price is determined by the competitive bidding. Okay, so someone will want to offer it at 102 rupees. Another one, because more and more people want to hold this bond. Let us say it is offering me 5% rate of interest. Uh, so more and more people want to hold this bond. Okay, and because it is offering you 5%, which is something which is cash cannot offer me. Okay, so this uh, price of bond is going up, but there is a limit. Okay, so by calculation I know that the present value of a stream which is going to give me 100 rupees plus 5% interest in 2 years is somewhere around 109 rupees. So this competitive bidding will not be able to increase the price of this bond beyond 109, because the moment it goes beyond that, this bond becomes unattractive, because the return which I will get, the price, the face value of bond is not the face value, the purchasing value of bond is already expensive than that. So this price will again come down, and eventually it will settle down at a price which we call as equilibrium price. I will show it to you here. Okay. So if this is the money supply, so this intersection between money and demand supply is known as the equilibrium price. Okay. And let us say the price of bond goes from 5% to 6%. Then the equilibrium goes from 109 rupees to 107. This is an approximation, and I know it because I have already calculated it before this session. Okay, so 100 रुपए का बॉन्ड है, 5% पे 109 पे मिल रहा है, 6% पे 107 पे मिल रहा है, which means that as the rate of interest is increasing, the bond is getting less and less attractive to me. I don't want to hold the bond anymore. I want to hold the money in liquid form. Okay, so what will happen? Yeah, so as the rate of interest is increasing, I'm interpreting this graph. Why is it downward sloping, negative sloping? As I'm increasing the rate of interest, the price of the bond is decreasing. So when the price of the bond is decreasing, there is more and more, uh, if I see that the bond is available at a discounted rate, I will want to purchase it, because in the future it will give me a better return. Or let us say simply that I'm getting this bond at a cheaper price. So I will want to reduce my demand for liquid money, my liquidity preference, and rather invest this money in the price of bond. So which is why, as the rate of interest increases, the demand for money is decreasing. The demand for liquid money is decreasing, because as compared to liquid money, bonds have started suddenly appearing more attractive to me. I hope this is you know uh, clear to all of you. You can pause the video here and try to replay it and try to understand it. I will just try to put it up in 3 lines, summarize this. Uh, First thing is that whenever I'm talking about demand for money, I'm talking about an opportunity cost of holding this money in cash versus investing it in any instrument. I'll generally call it as a body of instrument, which is bond. Okay. Secondly, this price of bond is inversely proportional to the rate of interest which is being offered in that bond, which means that as the rate of interest increases, the bond becomes less and less in price and more attractive, because you're able to get it. You're purchasing a mutual fund at a lower price. Okay, as simple as that. And when you sell it at a higher price, you will get more profit. So whenever the interest rate increases, the price of bond decreases, and consequently, the affinity or the tendency to hold money in liquid form will also decrease, because now I want to purchase the bond. I'm more attracted towards the bond. I hope this is clear. If any doubts, you can just directly message me or ask in the group. Okay. Now, using this curve, I know I told you that we will not spend much time here. We will first go to monetary policy, but I've just summarized this in theory so that it is easier for you to retain, and I'll just go through through this theory here. Okay, we are talking about movement along the curve. We will not talk about movement of the curve, which we will discuss after monetary policy. So what happens in an economy? Again, please note the topic is speculative demand. So this is all speculation. Okay, this is your individual tendency to speculate about the money. Whenever the interest rate is very high in the economy, interest rate of investing in a bond or debenture, a security, a gold or land or anything. When this interest rate is very high in the market, everyone expects it to fall in the future. Yeah, because that's how economy works, right? It goes from one high to low and then to high and then to low. So whenever the interest rate is very high, everyone will expect it to fall in the future. Now, what happens when uh, the interest rate is falling? The interest rate is inversely proportional to the price of bond. So the price of bond is increasing. It means that if you already are holding a bond, you will get a you will get a very good profit out of it. That profit from bond is known as capital gains, right? Because bond is a capital instrument. We know that, you know. So whenever interest rate is going to fall, there is a speculation that interest rate will fall. The then there is a anticipation that again this is all going in anticipation. एक उम्मीद एक जैसे हम बोलते हैं कि capital gain हमारा बढ़ जाएगा. So what people will do, if they are already not holding the bond, they will convert their money into bond. Everybody will start rushing to purchase mutual funds and everything. जो वो कहते हैं जब market is down, just go and purchase all those things. So invest in the market. Okay. So what happens is that as a person, if my tendency is to purchase more and more of bonds, my tendency to hold the money in liquid is low. So, which is why my demand for money, this is speculative, but I've put it in a bracket so that you don't get confused. Simply call it the demand for money, it is low. Okay. Consequently, as a reverse case, when the interest rate is coming down, okay, so people anticipate it to rise in the future. Let us say we are getting a very low return on any fund or any bond. People will anticipate कि यार ये भी कुछ time बाद में ये rise होगा. It is going too down for comfort. Okay, then if it is rising, interest rate is rising, the price of bond is falling, and there is a anticipation of capital loss. I might have to sell my bond at a cheaper rate than what I had purchased. It is a loss for me. So what people will do in speculation, they will convert this bond into liquid money. So the liquidity preference for money will rise. So in part, the speculation of the general public and of the people in the share market, it also causes a rise and fall in the prices, right? We all know that how speculation works. Okay, so this was movement along the curve. All both these 2 points can be explained with the simple curve. As you increase the rate of interest, the demand for money is decreasing. So we can simply say that the demand for money, speculative demand for money, is inversely proportional to the rate of interest. Okay, one simple mantra. Now, there is an effect of monetary policy in which the curves are shifting. This is explained by Sir in PPT 17, 18, 19, 20, I guess. There is one topic, liquidity trap, which he has not discussed, but we will discuss all of this later. First, we will go directly to monetary policy. Very interesting topic. Again, it has a lot of relevance in the exam as well and the practical life. Okay. Now, what are these two policies which we keep talking about? Monetary policy and fiscal policy. Simple line में समझना है. If the policy is made by RBI, it is monetary policy. If it is made by the government of India, it is fiscal policy. Okay. And why so? You can just go into the logic of it. Fiscal means anything which is related to the finance. So managing the budget is a part of government of India. Okay, the government has to, as a requirement in the constitution, it has to present a budget in the parliament, and then it discuss the fiscal deficit, the revenue deficit, and the primary deficit. All these things which are there in the fiscal policy chapter. and then they have to justify why this fiscal deficit is high, it is low. Then they have to introduce schemes like Atmanirbhar Bharat and all those things. So that policy making part is a part of government of India or the government in any country. The part where money has to be controlled, and the supply, and the credit creation and the supply and control of this credit has to be done. It is a part of RBI, because RBI is the custodian of government money. It is the primary, it is a monetary authority. So it's the authority which is responsible for injecting liquidity into the economy and sucking out liquidity when it is required. So whenever we're talking about monetary policy, it is the forte of RBI. Okay, RBI does not listen to government much here. Now, what are the various tools which are available for RBI at the hands of RBI? We already discussed that there are two kinds of tools, qualitative and quantitative. Qualitative may we would not be discussing much. It is just, as I told you, directions to the bank. It can be a direct notice which they send through fax, or it can be the governor of RBI in some conference. He's publicly appealing to the banks, ki please cut your rates. See, I have reduced the CRR and the policy rate and everything. Why are you not cutting your rates? Why are you not lending to the farmer agricultural sector more? Please lend more to the MSMEs. Why are you always focusing on people like Vijay Mallya? So all these moral suasion things are done under qualitative. Now, what is quantitative? This is how actually RBI can use the carrot and stick policy. It can penalize the banks, and it can. So this is a direct interaction between banks and, of course, for the sake of this subject, we had already discussed that we will only focus on commercial banks. There are other kinds of banking intermediaries, financial intermediaries, small Muthoot, finance, small Bandhan Bank, and all those things, ING Visa. We are not going to talk about them. We are only going to talk about commercial banks. Okay, but again, the principles with slight modifications they apply to the remaining banks also. Okay, so what are the quantitative tools? There are many tools. The first tool is fractional reserve banking. Okay, this is a general macroeconomic term. Please do not lose your sleep over this. Even if you are not able to understand, remember this term. Nobody is going to ask you in the exam. If, it is called by various names in all the countries, but the general term is fractional reserve banking. Why? Because let us say this is, we have a pie of resource funds available with the bank. Only a fraction of them can be lended further to create money to earn interest. Some of them has to be reserved, and how it has to be reserved depends on country to country. We will see how RBI does this. Okay, so RBI has two main tools of fractional reserve banking. First is cash reserve ratio, and the second is statutory liquidity ratio, SLR. Uh, how does this happen? Okay, let us say I am a bank. Okay, uh, we are just going to discuss how a general bank works, and I think almost all of us know about this. So I'm a bank. What I will do, I have two kinds of people I'm dealing with. First is the depositors. So you are an earning person. You come to me, you say, this is my salary, please keep it with you and give me some interest out of it. I say, okay, bro, 4% interest to you. Okay, so I have taken deposits from you. Now, there is one more person who says, I need to purchase a house, I need to purchase a vehicle. So please give me some home loan, some vehicle loan, some education loan, and you can charge some interest from me. So I said, okay, 9% interest to you. Okay. So I'm giving 4% interest to my depositor and taking 9% interest from my, you know, from the person whom I'm giving credit. The difference between this 5% is known as spread, and this spread is actually my earning of the bank. Okay. Now I know that if I have 100 customers who are depositing their money with me as a bank, I know not all 100 of them are going to come on the same day asking for all of their money. So I have some relief. I don't have to, keep all this money immediately readily available. 100 people have deposited 1 lakh rupee with me, and I need to keep this 1 lakh rupee. No, this money, if it is kept idle with me, it is a loss for me as a bank. I'm not a good bank because I'm giving 4% interest to those depositors. What am I even earning out of it? So what I will do, my tendency as a bank is to lend all of those 1 lakh rupees. I say ki they're not going to come in the single day, and even if five or six of them come, I'll just keep 1,000, 2,000 rupees handy with me to give them, and the rest I'm going to loan out. Because when I'm loaning out money, and not just loaning out, I'm investing it in some infrastructure funds. So banks invest in some very heavy funds also. They have a mixed bag, just like we invest. Okay, so I'll invest it in various profiles, and I'm going to earn money, interest out of them. So uh, my tendency is to lend as much money as I can. And this tendency of reckless lending is what actually causes a bank run. Okay, this is the tendency of reckless lending which has caused a lot of crises. Like the partly we can understand the Vijay Mallya and all those crises with this. This tendency to lend money and earn as much interest as I can. So RBI, as the monetary authority of this country, it has to ensure some fiscal discipline in the country. Okay, fiscal means financial discipline in the country. So it needs to ensure that these banks do not go for reckless lending, and they keep some reserve of money which is going to be used in case of a bank run. What is a bank run? Let us say if all my 100 depositors march into my bank today and say we need our money right now. This is known as bank run. And even if there is a speculation that Yes Bank is going to fail, almost all of their depositors will just turn up at the Yes Bank gates next day. Give me my money. I don't know. I need my money. So that is even going to exacerbate that situation of a bank run. So to avoid this kind of bank runs, all banks in this world, all central banks in the world, all in all countries are using this fractional reserve banking. Okay, I think we have given too much time to it, but I hope this concept is clear. So we have two kinds of main kinds of fractional reserve. The first is CRR, and the second is SLR. Okay, cash reserve ratio is that amount of money which RBI says to every bank, see, you have to keep this money with me, with RBI, in cash form, and this has to be kept only in cash form. No other form is acceptable. Okay, and there is no interest earned on this money. Why? Because it is kept with the RBI. If it was kept with bank, they could have earned interest on it or anything, but this is purely a loss for the bank. Okay, so this is how the RBI is controlling the banks by asking them. So currently this CRR rate is 4.5%. So they will ask every bank is required at all points of time to keep 4.5% of their NDTL. We have discussed this term. This is known as net demand and time liabilities. So 4.5% of these NDTL with the RBI in the form of cash and only cash. Okay, and this is a medium to short term tool to manage the monetary policy. We are discussing the tools to manage and control monetary policy, right? So it's a medium and short term tool, but we will see that not all of these ratios are used every time. Mainly it's the policy ratio, which we call as repo rate, which is the most important rate of RBI currently. Okay, these keep on changing every 15-20 years. So uh, that's the main tool to tackle the monetary policy. Okay, now the CRR is mandated. It has the backing of the law. It is mandated under RBI Act, which says that RBI can ask banks to keep 0 to 100%. So obviously 4.5% is nothing compared to 100. So RBI is not that strict. It won't ask the bank to keep 100%, but yeah, under the policy it is mandated. Again, this information is not very relevant, hence in a different color. The second rate is SLR, statutory liquidity ratio. Why statutory? I'm just trying to decode these words for you so that it is easier to retain them. Statutory means anything which has the backing of law. Again, a statute is a kind of law or a bylaw. So it is provided under the Banking Regulation Act, and it says that RBI can ask banks to keep between 0 to 40% of their money with themselves. This is not to be kept with RBI. So please note the difference here. with themselves, अपने पास ही रखो, लेकिन रखना पड़ेगा. And this is not just in the form of cash. No, banks can say, "अभी कहाँ से इतना cash लेके आएंगे? Already 4.5 you're asking us, and then 22.5% of my deposits in cash. Is it really profitable for me? Are you joking?" So RBI says, okay, not just in cash, you can keep it in certain liquid assets. No, they have to be liquid assets, but and this is specified by the RBI from time to time. So what does it contain? It can contain gold. Okay, gold में रख लो थोड़ा सा treasury bill में रख लो. Again, uh, these are all government backed securities. They are hard to fail. Too critical to fail kind of securities, because they either have the backing of the government, or they have a universal acceptance value. Nobody in this world is going to deny gold as an acceptance value, right? So these kind of specified liquid assets, can keep with themselves, but then they have to keep it. That's the requirement. And of course, RBI, the banks are also liable to earn interest. So this is at least some relief as compared to CRR, which is very strict. And currently, this is at 18%. It's a long-term tool, and these tools do not really change. So uh, the CRR was at 4% for a long period of time. Then during COVID, it came down to I think around 3% or something, and then RBI has gradually raised it again back to 4.5%. And this SLR has been dwindling between 18 to 19% for the last 20 years. So these are not the main tools using which RBI is controlling the banks on a daily basis. These are just some safeguard tools which are mentioned. So much for fractional reserve banking. Now, and again, please, there are a lot of other things, liquidity, coverage ratio, incremental CRR, standing deposit fund, all those things. These are opportunistic ratios which have been introduced by RBI from time to time, especially when there is a COVID crisis, they will try. So these are extraordinary measures for extraordinary times, not at all important for exam perspective. If you see them in some resource, some book, please ignore them. And again, as I mentioned, they are not the main tools for monetary policy. They are just some mandates. Okay. Now that we have learned about CRR and SLR, I will deviate from the monetary policy for some time, and I will introduce one more topic, very important for the exam again. This is how do banks create money using the money multiplier. Okay. Uh, for this, we needed to study SLR and CRR, and hence we covered that. Now that we have done it, we are going to learn what is a money multiplier, how does that work, and this is mentioned in slide number 9 to 13 of Sir's PPT. You can also go through that. Okay, we are looking at a typical balance sheet of a bank. Again, this is not very exhaustive, does not contain everything, but it contains the things which are important. So what is a balance sheet of a bank looking like? There are certain reserves cashed with RBI. Now you know what we are talking about, right? इसको हम CRR बोलते हैं प्यार से. Then there are certain loans which banks has given to uh, certain individuals and corporations and bodies. It is also an asset because RBI is, I'm sorry, the bank is earning interest on them. And then there are certain other assets. Other to hamesha rehta hai, there is miscellaneous always, so there is other liabilities. And what are the liabilities of a bank? The deposits which the public has held with them, and there are some capital liabilities, for which it is required to pay interest or pay dividends and all those things. So this is a typical balance sheet of a bank. Now, how does a bank help in money creation? Okay, RBI, we saw that RBI is the supply side of money. It gives us what we call as M naught, which is the uh, high powered money or monetary base of the country. So RBI, we will see that even if RBI is injecting, it is printing 1,000 rupees worth of currency, it can actually reach to a potential of 10,000 in this hypothetical example. It can be much more or much less, but in this hypothetical example, this money is getting multiplied. As we call in the economy, पैसे से पैसा बनता है. Okay, so how does this happen? Let us say RBI wants to inject some money into the economy. What it will do? It will purchase a bond from an investor. Let us say there is an investor, Muthoot Finance. It purchases a bond worth 100 rupees. Okay, so this bond is going to RBI, and in response to that, obviously it will give it cash of 1,000 rupees. Now, RBI giving or taking cash to any person, any body, any government, any bank in this country is very, very, very different from me and you giving and taking cash. This is the authority which is printing cash. Okay. So if it is giving or taking cash, it means it is not just transacting, it is sucking or infusing liquidity into the system. So if it is giving cash, it is infusing liquidity into the system. And if it is taking away cash, it is taking out liquidity of the system. Okay, so RBI gives cash, which means that it prints fresh currency notes and gives it to the investor. Now, what will an investor like Muthoot Finance do? It will put this money in bank. Investor can also be an individual. So whenever you get money, what do? You put it in bank. And let us say RBI has set the cash reserve ratio at 10%. So currently it is at 4.5%. But in this example, let us say 10% of bank's reserves have to be kept with RBI in liquid form, no compromise. And for the sake of this example, we are assuming that there is no other requirement. There is no SLR, there is no repo rate, no reverse repo, nothing at all. Now, what will happen? Investor puts it in bank one. Okay. We are taking a look at the balance sheets of these banks. So in the first bank, you have put 1,000 rupees, 10% has to be kept as reserves. These are reserves with RBI. So 10% of 1,000 is 100 rupees. The rest, 900 rupees, this bank one is free to lend, to give to loans. And of course, on the deposit side, it is 1,000. So the balance sheet is matching. Now, this 900 rupees, it can give to loan. So let us say it is loaning it to another person who has his account in bank 2. So it puts that money in bank 2. Bank 2 again, the CRR is at 10%. So the reserve is 90 rupees, which it has to keep out of 900. And the remaining 810 rupees it can loan out. This loan money is given to a third person who puts it in bank 3. Again, using the 10% CRR, it keeps 10% or 81 rupees in reserve and 729 rupees is loaned out. This process continues till infinity. Right? We have all the banks and everything. So this is how money is exchanging hands. So now we will see what is the total money supply created due to bank 1, 2, and 3, because they are loaning out this money. So the initial money which was infused by RBI was 1,000 rupees. And let us see how banks 1, 2, and 3 have created that supply. So bank 1 is loaned out. The bank 1 has a deposit of 1,000 rupees. Bank 2 has a deposit of 900, then 729, and it goes on till infinity. So I can say that ये 1,000 to 1,000 था ही जो RBI से directly मिला था. ये 900 क्यों आया? Because there was a 10% reduction due to CRR. Similarly, there is a 1 minus CRR square का reduction. ठीक है? You can assume mathematics folks understand that this is a geometric progression. And it is an infinite geometric progression which is going towards the reduction side. It is decreasing. So the sum of this infinite GP will come out to be 1,000 upon CRR, which actually comes out to be, CRR is 10%, so this comes out to be 10,000. Okay, so we can see that out of 1,000 rupees infused by RBI, the banks were able to create, we just took example of 3 banks and they were able to create 10,000 worth of money. This is how money multiplier works in an economy. Very important concept. And for the sake of this discussion, we are assuming that there is only one rate, which is CRR. So 1 upon CRR has been called as money multiplier. Of course, in practicality, it is a much more complex formula, but you can use this formula in the exam because sir has mentioned this formula in the PPT. So money